Hello and welcome to Money, 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 your weekly personal finance date with me, Sumaira Abdi. A few months back, I was startled to read a survey by a consumer finance company which showed that 77% of working India relied on personal loans to make ends meet. And some of these requirements included medical emergencies, children's education, home renovation, even wedding expenses. So given this high prevalence of loan requirements, I wondered if it was possible at all to live without taking a loan at some point, and more importantly, whether loans themselves could be good or bad. So to take this thought forward, I've invited two experts, Prableen Bajpai, founder of FinFix Research, and Aparna Ramchandra, founder and director of RectifyCredit.com. Prableen is a financial planner and Aparna is a credit consultant. So between them, they will cover all aspects of this topic. Ladies, welcome and thank you very much for talking about this. Prableen, first to you. Is this prevalence of taking loans really that high? Are more and more Indians opting for debt, and how big a worry is it?
Good afternoon, Sumaira. Yes, the personal loan, the percentage definitely continues to rise in India. And over the years, there's some data by RBI, which I'd like to talk about. There's deployment of how the gross bank credit is basically divided. So the broader basket is your personal loans. And within that, there are 9 different segments, which the RBI report covers. And it's given out, the figures I have covered are from January to January. And it actually shows that 2018 and 19, we saw a 16.9% growth. Even 19 and 20, we saw a 16.9% growth. And of course, 2021 was the year of the pandemic, and we continue to somewhere face the same prices, 2021 and 2022. So there was a minor reduction. The overall figure went down to 8.7% and now at 11.6%. But all this is still higher what we saw in 18 and 19 as compared to what it was in 2011-12 when it was 13.2%. So broadly, Sumaira, this report plus the RBI other reports have been pointing out the household debt to GDP has overall risen in India, and especially during the pandemic. And 2 broader trends which I like to highlight here. Number 1 is the rising comfort with debt. Over the years, how debt is perceived and how it is marketed and projected has changed. And taking loans and financing purchases is being normalized. That's one trend that we are seeing. Second, Sumaira, that the loan basket, how is that constructed? These various different sort of loans which are there in these figures reflect that there is a high percentage of loans which were taken against gold during the pandemic, which definitely shows that there was crisis in households. And because personal loans are not that easy to get, the regular personal loans, they're at higher rates. So loans against gold, they really shot up. We see that the education loans have actually gone down over the years from, about a 13.4% growth in 11-12. It has been sliding only in the last 4 years, 2.3% reduction, 3.1% reduction. And even in 2021 and 2022, we saw 3.7 and 2.4% reduction. We've seen that the consumer durables, the loans against that continues to increase. We are seeing that the personal loans continue to stay robust. And amid all of this, as soon as the markets, recovered a bit, we also see that in 2021, 2022, there has been a huge increase again in the advances against, shares and bonds. So overall, all of this definitely projects that the dependence on loans, the loan baskets that households have now is not typically just constructed of home loans, because home loans out of this whole figure is only at 7.6% currently. And this is only the bank side credit. Now we have a rising percentage of NBFCs being a player in the market, and they're facilitating a lot of loans, especially when it comes to vehicle loans for buying vehicles and consumer durables. So overall, Sumaira, yes, the trend is there. It's in the upward direction. The debt component is rising. And I think the worrisome fact is that we are no more looking at the affordability of loan, in terms of the holistic number, that are you taking a 20 lakh loan or a 1 crore loan? It is, increasingly can be seen as whether you can do the monthly EMI. So it's the affordability of EMI, which I think a lot of people are checking these days and taking loans.
Absolutely. And, it's this whole aspirational value which these loans are sort of targeting. But Aparna, are, all loans bad? Right now, how do I differentiate between what is good debt and what is bad debt? And therefore, what is the debt that I should be taking on?
Hi, Sumera. That's a very good question. Like, based on what Prableen said, definitely the number that is taking the loan is increasing. Now, a good debt is something that you sign up for where you are, taking up that debt to build an asset. So you are kind of building portfolio. So any debt that you take for that is a good debt. So, for example, a home loan is a good debt, a mortgage loan is a good debt. And I will stick my neck out and say, even an education loan for me is a good debt because you are investing for your future. So, there are people who say education is an unsecured loan, so it should not be part of that. But for me, an education loan is also a good loan. Now, what is a bad debt? A bad debt is typically a personal loan that you take to pay off your credit card dues, or you are taking a personal loan to invest in the stock market. You are taking an auto loan. For me, an auto loan is again a bad debt because it's for buying an asset that is going to be a depreciating asset. So the minute you buy the car and you move out of the showroom, we all know that the value already gets depreciated. So an auto loan for me is a bad debt, but a home loan, a mortgage loan for me is a good debt. So the percentage that is there, good versus bad, is what we need to be constantly monitoring in the system. And but if you see the RBI data, sadly, the bad debt component is increasing. The good debt is now slowly coming down, which is a little worrisome concern.
No, absolutely. And, which is why I wanted to do this in the first place, to highlight this point that, there is good debt too, and that is where the focus should be, and not really on just, gratification of our requirements. But Prableen, in a person's overall financial plan, where does debt figure, right? And how to go about sort of managing it in the optimal manner?
Right, Samira. So like Aparna has pointed out, there is good and bad debt. So it's okay as long you have certain component of good debt in your, overall portfolio, let's say, the loans that you have. And of course, managing debt is a very, very crucial component of the overall financial planning process. And I think bringing that under control, if you have too many loans, and, gradually reducing the bad loans and bad debt, that is what is very important in financial planning. So I think, Sumera, the process starts with first knowing that how many loans do you have? Because I have seen that people have, at least 4 to 5 these days, especially the younger generation. Slightly older generation, you'll see that usually it's just a home loan and sometimes a vehicle loan. But in younger generation, you do see credit card loans, you have personal loans as well. So it's very important to identify what is the current debt, what is the tenure, and what is the interest rate that is being paid. So that's the first step. How do you put it, in the overall planning process? Second, Sumera, now how do you get rid of that? So there are different approaches to this. The first is that, you get rid of a debt, which is, of course, at a higher interest rate. And this is called the debt avalanche strategy. So you just target what is the loan which is being paid at a very high interest. Second strategy says that you just see that how much component of each loan is there. And it's called the debt snowball method, where you just get rid of the smaller components so that the number of loans that you're having goes down. Then you go to checking what is the real benefit that that loan is actually giving you. A lot of people like to stick to their home loans because they feel that it's giving them a rebate at the end of the year. Sometimes they like to stick to the education loan. But education loan also has a lifetime. So till 8 years, you can avail the tax benefit. Beyond that, you cannot. So doing this check on what is the real benefit or the tax benefit that particular loan is giving you is very, very crucial. And other than home loan and education loan as it is, there are no other tax breaks that we get. Second, then moving on, exploring the prepayment options is very important. When you're doing it, how do you do it? Is there a position where you can close a certain loan and probably finance it through a lesser interest bearing loan? Or how do you restructure? Can you negotiate with the person, the institution, or can you shift it from a particular institution to another institution where you may be getting a lesser interest percentage, the loan at lesser interest? And then I think a very, very crucial component of this overall thing is, Sumaira, how much is your own insurance cover and what are your loans? I have seen people having an insurance cover of, let's say, 50 lakhs and then having home loans of 70 lakhs. That means that, forget about anything being given to the family. The whole amount, and in fact, their own savings would be going to repay that loan. So it is so important when you're having huge loans on you to check what is your insurance cover. Is it able to cover that part as well, especially for loans which are for longer duration? For example, loans against your business, if it's a proprietary firm, or your home loans, what is the component? And I think individuals who are taking huge loans should also try and get their insurance covered under the Marriage Women Property Act, wherein any creditor cannot ask for the loan payment from the wife, especially from the insurance amount that she receives. Well, so broadly, this is how you bring it together with your financial planning and work on reducing your debt and then eventually becoming debt-free, because that is stress-free. And I think it's a very, very healthy thing to achieve.
No, absolutely. So this is an important point that, debt should be looked at as part of the overall financial plan and not in isolation, and certainly not, different loans in isolation. But Aparna, why is debt so important? I mean, is there a scenario in which a person can sideskip debt entirely, buy only what they can afford to pay for, or is that not a desirable concept in itself?
See, today, fortunately or unfortunately, we are in a scenario where we cannot.
Okay, we'll try and reconnect with Aparna, but basically the point that Aparna is making is that, in today's day and age, it is not possible to be entirely debt-free, and it is also at some level not a very desirable concept, because if you don't have your credit history, it can be an impediment in the future. So you want to take on loans which you can service. You don't want to live entirely a debt-free life as well, because that in itself can also be a impediment. But we're going to take a very quick break. We'll come back and continue this interesting chat on the other side. Do stay tuned. Welcome back. Prableen Bajpai of FinFix Research and Aparna Ramchandra of RectifyCredit.com are with us talking about good debt and bad debt. Aparna, glad to have reconnected with you. I wanted to ask you, why is debt so important, and is it not desirable that a person skip debt entirely?
In today's scenario, like I was mentioning, it is very difficult to build your asset portfolio without the debt component. Okay. So having said that, it is very important that you see debt as something that is going to be building your portfolio, not crippling your portfolio. So one is that. Now, the second thing is, you should not be taking debt just because you have access to debt. So take debt only when you know for a fact that you can repay that debt. Otherwise, don't get into that debt. Number three, to answer your question, today, it is not possible that you get into something and then in the middle suddenly decide that, this is not working, and then I decide to just stop this debt, because that is where you will get into a lot of your credit, profile issues. You will start defaulting, and all of those issues will start. But of course, we do not want to encourage these, buy now, pay later kind of a thing, or getting into a loan where the EMIs during the entire tenure of the loan, you are not able to service. So those are things that you need to be careful. Otherwise, if you are very comfortable and like, Prableen said, do that financial planning, do that math. If you know that you can, completely service this loan throughout the entire tenure, only then go for the loan. Otherwise, do not go for the loan. And secondly, do not get into loans which you know for a fact you are going to be paying way beyond the normal just because you feel that you need that loan. Need and want, if you are able to differentiate, then I think you're on a good wicket. But overall, it is very difficult to manage a portfolio today without the debt component.
Yeah, so basically adulting is hard, but in this case, it must be done. Aparna, because we have stressed so much on, taking loans only which can be serviced, just want to put on the table, what are the consequences of not repaying loan? And, is there any course correction possible?
It is very simple. Now, all of us know that last 2 years, there were quite a few of us who could not repay the loans because we had cash flow situations. So if you do not repay, one is you're going to have the collection agent starting to hound you. Second, you're going to be reported as a defaulter. Third, your future options to take loans further when you really need it might get completely hampered. So these are three scenarios what will happen if you do not repay your loan. But having said that, course correction is, I have always encouraged and I have always believed that if you are able to talk to your lender before they come to you, go to your lender, discuss your scenario, put things in paper that this is the issue, let me know how can I do this better. So the lender has the option of reworking your EMI, maybe increasing your tenure, maybe giving you some periods where he will let you only pay the interest, not pay the principal. There are multiple options available, but if you go and discuss this, that is where the solution is going to come. Dodging the bank's calls, not answering their emails, just going silent and then crying horse from the rooftops when the thing has hit the roof doesn't work. So please go upfront, talk to your lender, tell the situation, talk the truth, tell the situation, and there are options available.
All right, that's a good point, that basically communication is the key even in this. Prableen, would it be preferable to prioritize the repayment of loan as against saving or investing?
This is a question I'm often asked, actually, Sumaira, especially, even my own clients. So I think let's look at it, the lowest interest rate that we are paying is actually on a home loan. And the maximum is, of course, on the credit cards. And the lowest is currently in the 6.5 to 7.5 range. And none of the safer options in the market, let's say a fixed deposit or a debt fund, is actually going to give me that sort of a return. So firstly, that if I have the lowest loan bearing, like a home loan, still I cannot fund it if I, or, sort of compensate it by investing in a risk-free asset. Government schemes are available to us, but all of them come with a lock-in. So a PPF would come with a lock-in. If I'm doing a NSE, it would come with a lock-in, and that's in the 6 to 8% range. So broadly, the options are limited if you want to keep that money parked in an option where it is safe. So you have to undertake risk. If you want to, now look at education loan and personal loans, again, the interest paid is so much higher that none of the investment options can actually totally negate it. Property also, the rental yields are, let's say, about 3%, and appreciation can be taken as 7%. There will be taxes on your rental yields as well. If you're looking at equity, then also it involves, volatility. It involves entering an asset class where there is risk. And just imagine being stuck in a situation where you didn't pay up your loan and you invested in equities. And we are in a scenario like today's when there is so much uncertainty in the equity markets itself. So broadly, one line, in one word, it would be that no, you should repay your loans first. But it may not imply, on everybody, and scenario can be different. So I think certain factors which investors and individuals should consider is the type of loan. Is it giving them a tax break? Yeah. What is the interest that is paid on it? What is the remaining tenure of that loan? I think, Sumaira, this remaining tenure is also very important. For example, somebody has a home loan and you've paid it for 10 or 11 years and it was a 15-year-old loan. So now broadly, the amount which would be going as your EMI is your principal. So you're not really paying any interest now in the later years. So just continuing with the loan can also be a decent option, and investing that amount of money if you have some lump sum in the markets or based on your financial goal. Or even for a vehicle loan, let's say there is a foreclosure charge and just about a year's EMIs are left. You may continue with that. So I think the remaining tenure is also very important.
Understood.
Next is your overall financial situation. Are you in a government job? Are you in a corporate job? Or are you, part of the gig economy where your incomes are variable? What are your other goals and investments buffer in place? Yeah. Very important component here is your debt to income ratio. It should be. So if you're earning 100 rupees, your debt ideally should not be more than 40 rupees out of that. Probably, and that's the higher limit.
Got it. I'm so sorry. I have to interrupt you, but we're actually now running out of time. But this has been a very interesting discussion. And, definitely there is scope to take this forward as well. And we will. But for now, the key takeaway is that there is this growing normalization of taking a loan to the extent, like Prableen said, that people are checking the affordability of the installment of the EMI and not really the loan itself. So beware of that. And do remember what Aparna said, which is that a good debt is any debt which helps in the creation of an asset and not in repaying high interest dues. With that, we'll wind up on this edition of Money, Money, Money. Do stay tuned to CNBC TV 18.